Today, I'm just gonna go over the Japanese economy from a macro perspective and how that ties into the sudden yen strength we saw on 22nd of September, right? The specific events that I'm talking about here is the one below, where the Japanese government steps in the market to buy yen for dollars and conducts the first FX intervention since June 1998. Now, this event did confuse a lot of traders, and a lot of people don't know what this is and how this impacts markets. But I'm going to use this as an opportunity to explain to you guys how the Japanese economy is set up from a fundamental perspective and how that will lead to into the future. However, though, I do also highly recommend watching a documentary called Princess of the Yen, right? This documentary specifically will deepen your understanding of how central banks and politics influence the financial markets, including the FX markets. So if you do have some time or you're bored, make sure you watch that. Now, before I start, I want to go over some basic macroeconomics, right? Every economy is built up of two major parts, right? One is the central bank, right? The second is the government. What a lot of people don't realize is that these are completely two entities. The majority of people within an economy or nation think that central banks and the government are one of the same. They're not. They're completely two separate entities, and one definitely holds more power over the other. So the government, they oversee and deal with everyday political policies, right? Essentially making sure that everything in the country runs smoothly, from healthcare, laws to education. The government is much closer to the general public. Meanwhile, central banks, they deal with the economy and the financial side of the country. This would include interest rates, money printing, inflation, pumping up the markets, etc., you name it, right? Now, the government and the central bank do work hand in hand, but at the end of the day, it's the central bank that runs the economy, right? Who do governments go to get loans from when they want to build new roads, or for example, they want to wage wars? They go to the central bank and get these loans on interest. Again, what most people don't realize is that the government has minimal impact on the economy. The general public only see the relationship between them and the government because they think that the elected government that they voted for, that they run the economy. That's completely absurd. The masses actually believe that the same government they elected based on how many, cycle lanes or how many public spaces they want in cities actually has power over the economy. That's completely false. What they don't see is the relationship between the government and the central bank. Governments don't impact financial well-being of the economy and thus the people. Central banks do. And when central banks mess up, the masses blame the government. Nobody looks at the central bank. Let me ask you this question, right? When was the last time you got to elect your own central banking representative? Do you know what I'm talking about? Right, it's the perfect finesse, and it's happening right under everyone's noses, right? For example, inflation is high. Cool, we'll elect a new government party next year. Little do the people know that it's not the central bank, it's not the government that impacts inflation, right? It's the Federal Reserve, it's the central bank that caused the high inflation, right? This is why central banks hold all the power, and elected governments is just a facade. It's just a mask to put the blame on when they mess up. And they do mess up, right? Yet 99% of the population have never heard of the central bank. And, they're going to keep it that way. Now, this is not to say that the government has no power at all. It does, but to an extent with the financial side of the economy. And I'm sure we can all agree that the financial side of the economy is more important than, for example, how many green spaces or how many bike lanes or, taxi or, parking fines and whatever of the economy, right? Now that we know the basic makeup of an economy, i.e. the government and the central bank, we can assume that the majority of economies post World War II, again, this is very important, whatever happened, how the situation ended up being after the World War II, winners and losers, that has still an impact on governments and economies today. So the winners of post-World War II with the winning economies are very similar in nature and experienced the exact same economic problems and economic times of prosperity, right? This is true for the United States, for Canada, UK, Europe, etc. Simply because these nations, right, US, Canada, UK, Europe, they were war allies. This led to these countries having similar economic setups. Now, this is not true for Japan, because Japan was on the losing side of the war. Japan faced a completely different host of problems and challenges that made the Japanese economy stand out from the rest, although the basic makeup of the economies is more or less the same. For example, Japan has always struggled with deflation and low economic growth. This is due to geographical factors, and thus the Japanese economy heavily relies on imports and exports. So Japan had been dealing with this deflation crisis stage for decades coming out of the war era, and they had to accelerate inflation to boost the country's GDP. Now remember, deflation is bad for the economy. Inflation, to an extent, for example the 2% rate, is good for the economy. As long as there's inflation that is under control, it means that the economy is growing, GDP is rising, and there's economic prosperity. But because from an economic perspective, rising inflation is good for this economy, for the Japanese economy specifically, it means that the economy is growing and there's prosperity. Now, the Japanese economy, they've been doing quite a good job at keeping interest rates low and in the negative pre-COVID. They had been stimulating the economy for decades and all was good. It was one of the G7 countries and had strong economic power within the world. Until COVID-19 happened. As soon as COVID-19 lockdowns came on the scene, all that progress of decades of stimulating the economy, decades of keeping interest rates low or in the negative, was lost. Again, because the Japanese economy relies heavily on imports and exports and tourism to keep GDP rising, they can be described as a fragile economy. And a massive blow such as COVID basically brought the Japanese economy back to square one. And this is the reason why the Bank of Japan has had such a loose monetary policy around interest rates since the start of the pandemic, and the fact that it's still 3 years loose 3 years later, we can expect this trend to continue. Now, this is specific to Japanese economy. Low interest rates means more economic activity, which means more inflation, because by default, the Japanese economy struggles with deflation due to geographical factors, right? And interest rates is not the only way to stimulate the economy. Another way to do that is through the Bank of Japan having an unlimited bond buying program. Essentially, this means that the Japanese government can ask for unlimited money from the Bank of Japan and invest that in infrastructure, business, stocks, schools, hospitals, whatever it is. In other words, to pump up the markets, all to promote growth and accelerate inflation. Now, in terms of Forex, because essentially that's what we're trading here, right? Because the Bank of Japan has been so dovish, right? Low interest rates, this leads to a downfall in the strength for the Japanese yen on international markets, right? This has to do with supply and demand. I'm sure all you guys know about supply and demand, but again, international investors buy currencies with higher interest rates, for example the dollar, because this yields a higher return on investment. Why would investors buy a currency with low interest rates, which leads to a low return on investment? What this does is it increases the supply in the yen in the world because nobody's buying them, and reduces the supply of a higher interest rate currency such as a dollar. Now, simply put, high supply plus low demand plus Bank of Japan pumping markets, this leads to low currency strength. That's the situation that the Japanese yen is in right now. And for example, low supply, high demand, plus the Federal Reserve doing quantitative tightening, i.e. removing the amount of dollars in the world at their own pace, this leads to high currency strength for dollar. Therefore, we have USD JPY going up and up and up, for example. Now, this is the same for other currencies, GBP JPY, Australian JPY, Canadian JPY. Any country that has a high interest rate combined with a country with low interest rates, it will always go up. Now, the question is, does this not hurt the Japanese economy? It does. A weaker currency is less attractive to investors, and it's not good for the residents of the economy itself. because small businesses, they end up suffering from this. However, this is only in the short term, right? Once the business starts booming in Japan due to the unlimited cash that the Bank of Japan is pumping in its own economy, in the long run, this will hopefully pay off, right? Now, to recap what we just said, now we understand the basic makeup of an economy, the government and the central bank. Now we understand how post-war played a huge impact on the economies today and how the Japanese economy is set up because of that. We also now understand why the Bank of Japan has kept such a loose monetary policy and how it will continue to do so in the future. We also now know how this impacts the FX markets. Now, going into what people are interested about, this specific event here in red, we saw the government of Japan, not the Bank of Japan, keep that in mind, the government of Japan, right, finally taking some action to strengthen the yen for the first time in 20 years. Now, if you've been following the Japanese economy, you'll notice statements made by the Bank of Japan, not the Bank of Japan, by the Japanese finance minister, which is the Japanese government. You'll notice statements made by them. They're saying, we're not happy with the current FX markets, we're not happy with how our currency is currently behaving, we're not pleased with this volatility and how aggressively our currency is weakening against other currencies. Again, these are just comments, right? But it's interesting how they've been saying these comments and statements for the past 18 months and they're letting it happen, right? This just tells me they're not saying these comments and statements to actually do something about it. They're simply saying these comments and statements to please the masses, right? At the end of the day, the middle class is the powerhouse and workhorse for the economy. So keeping them happy is the government's job through statements such as these. Again, with that being said, the government of Japan released that statement on September 22, 4 a.m. EST. What's really interesting though is that around the same time, the Bank of Japan released its interest rate decision. Now, obviously, the interest rate decision remained unchanged and stayed negative. But without the government of Japan's statement about currency intervention, this would have caused too much downside and volatility on the yen. That would have upset the economy even more. Hence, they let this short-term action take place of currency intervention to mitigate the downside that will come from the Bank of Japan rate decision. This just, like, if you just analyze this, you'll know that the Bank of Japan, again, Bank of Japan and the government of Japan work hand in hand. And this is the perfect example of that. The government of Japan knew that the interest rate decision by the Bank of Japan would remain unchanged, and they knew this would cause further weakness and further downside and even more volatility in their currency. And so what this did is they released this specific statement about FX currency intervention to allow some strength and relief within their currency. Essentially a short-term boost to please the masses. That's literally all it was. That is all it was. In conclusion, this event did upset many traders and did confuse them, but with the above being said, it's nothing more than a short-term political move to appease the masses, right? And now that we know this, now that we've analyzed this, we can be safe and continue with our higher time frame bias of Japanese weakness. Because again, the Bank of Japan runs the show. They've stayed the same in all aspects. Interest rates still in negative, unlimited bond buying program and high stimulus still active. This event will do nothing to mask the higher time frame macroeconomic player and their sentiment, which is the Bank of Japan. Now, even if we look at recent price action, we did see huge volatility from that specific move. But what happened, if you look a bit closer, right, we can see it being faded out quite soon. Right, if you compare this price action compared to that price action, we can see this was not sustained. This was not sustained whatsoever, and that just tells us that this is just nothing from a technical perspective. It just validates our idea that this is a short-term move, nothing more, nothing less. And I'll even show you guys on the higher time frame. If this move really did hold any weight, we would have made a bigger move on the higher time frame. But again, we're already seeing some consolidation exhaustion right after it. So even on the lower time frame, this just tells us that this move was nothing other than just to please the masses, just to keep the masses happy, just to keep the middle class happy with the little intervention that they done. But on the higher time frame, it still stay the same, right? But yeah, that's pretty much it from me, guys.